see him in the green room there. He looks like he's ready. We have up next Safehold Inc. The ticker is SAFE. You made it nice and easy. And we have Ian Selig. He is the Assistant Vice President of Investor Relations at Safehold. Ian, how's it going?
It's going well. How you doing?
I am having a fantastic Friday. I love alliteration, so I'm going with Fantastic Friday, the two F's. How you doing?
Likewise, lovely. How you like that?
Likewise, lovely. Thank you for playing that off with me. I will let you have the airwaves, sir. Take it
Terrific,
away. Yeah.
terrific. Well, good afternoon, everybody. Actually, depending where you are, I'm here in New York, so it is afternoon. If you're further west, maybe not yet. But happy Friday. I think that would count. I'm delighted to be with you all to discuss Safehold, a truly unique investment in a world of Me Too ideas. So I have about 20 minutes or so of prepared remarks, and then hopefully we'll have enough time at the end of the presentation for some Q&A. Today's presentation is broken up into two parts. The first walks through our business model, but then, most importantly, the second describes the investment in Safe. I think that we'd all agree that before we ever decided to make any investment, it's really important to understand the fundamentals of the business behind it. So to begin, Safehold is the first and only publicly traded company that's focused on ground leases. We are listed on the New York Stock Exchange, and as you just heard, our ticker is SAFE. Now, many of you may be familiar with ground leases, but for those of you who are not, allow me to give you a brief primer about ground leases. They're pretty easy to understand. Well, okay, so it's actually perfect timing. So as I was saying, we're just going to do a little brief 101 primer about ground leases, since we are the first and only publicly traded company that is focused on ground leases. So any piece of commercial real estate is literally just two components. It's the land and it's the building that sits on top of that land. And in a ground lease structure, we separate those components, and one party owns the land, and that would be us at Safehold, and another party leases that land for a long duration, typically 99 years. The tenants of that building are, in effect, the owners of that building. They're responsible for all expenses. They're under a triple net lease, meaning they pay the taxes, the maintenance, the insurance. Any capital expenditures are on them as well. But also any net operating income or profits that that building kicks off is theirs to keep. So one thing about ground leases are, at the termination of the lease, like some other leases that we could think about and talk about later, not only does Safe get its land back, but it gets the building and all its improvements back as well. So I know a lot of you are thinking, why would a real estate investor ever consider such an ownership structure? Because we're all somewhat hardwired to believe that you must own the land and the building together. Well, the simple way to understand Safehold's business is to realize that every time someone buys the property, they're really buying two things. They're buying the land and they're buying the building. But those are very, very different investments. The building is the higher return operating part of the business, where all the leasing, designing, managing, and marketing needs exist, making it a very active investment. The land, conversely, is the quiet, passive, lower return part. And it's much more like a bond, in fact. And the truth of the matter is, there's no other place in the investment world where those two types of investment are forced to be together. For example, in the corporate world, you do not have to buy the bonds of a company to buy its stock. That would be considered senseless, entirely inefficient. But that's what's been happening in the real estate world, because there's never been a nationally scaled institution to acquire that land component and do it in a way that actually enhances the value of the building. And that's our value proposition. And the math is pretty compelling for building owners. By selling that relatively low return land to Safehold, and by creating a properly structured ground lease, owners earn a much higher return on their buildings, and they do it with less risk. And as you will soon see, it's really a win-win for all of us. So Safehold ground leases have created three very important efficiencies for building owners. First, There's a capital efficiency because, as I just explained, the land and the building are very different investments. And by separating them, building owners earn a higher return with less risk. And by just buying the building itself, you utilize obviously less upfront capital needs than if you would just do with typical fee simple investments. Next, there are substantial cost efficiencies that are associated with the various friction costs every time that building sells, which could be 10 or 15 times over a 99-year period, such as mortgage taxes, brokerage fees, all of which are based upon the entire purchase price of both the land and the building. And lastly, and maybe most importantly, there is significant maturity risk reduction on a large portion of the capital structure because we're replacing it with near permanent capital, 99-year capital. So actually, this whole idea of separating the land from the building via a ground lease has been around for centuries. And over that time, it's really proven to be one of the greatest wealth creators for a very elite group of landowners. In New York, where I am from, the Chrysler Building today is on a ground lease. Cooper Union University owns the land under that building. Trinity Church owns much of the land in downtown Manhattan, and a lot of the buildings on Wall Street are on ground leases. Some of the wealthiest families in New York, in fact, have attained their wealth because some patriarch 100 and 150 years ago realized that that land was going to be worth a lot of money. London, another great example. The Duke of Westminster bought West London 150 years ago, and it was primarily apple orchards and swampland at the time. Today, the royal family receives close to 100 billion pounds of ground rent every year from that purchase of that land. And probably one of the best examples is the picture on the bottom of the slide, which is Hong Kong. The British leased that land from the Chinese, built this megapolis on top of this tiny little island, and literally handed the keys back to the Chinese in 1997. But quite candidly, these ground leases of the past have had an awful reputation because most of these old-fashioned, archaic ground leases contained negative provisions such as arbitrary rent resets, required permissions for just about any improvement, and were really written to be very one-sided toward the landowner, which would make these leases value destroying for the building, not value enhancing, and created two things that the markets despise: uncertainty and ambiguity. Look what was just happening with gas prices just a couple of days ago. So at Safehold, we recognize that the problem is that nobody has taken this fundamental idea and modernized it to work in today's capital markets. But there's still more that makes any business really revolutionary. Many of the biggest and best companies today are being built by rethinking how things were historically done and delivering fundamentally better solutions while offering a better customer experience. Think about for a moment what Amazon has done for retail, what Uber and Lyft has done for the taxi service, what PayPal and Venmo has done for payment processing. Utilizing this proven formula, Safehold is literally taking a $7 trillion real estate industry and making it more efficient and delivering a better customer experience. This idea is revolutionizing the way property owners think about their buildings and the land underneath them. So let's see how our portfolio has penetrated the market since our inception. So at Safehold's IPO 4 years ago in June of 2017, our portfolio consisted of $300 million of these ground leases. Safehold really gained traction in 2019 by closing $1.8 billion of deals and grew our portfolio to approximately $3.4 billion today. And since we are focused on the top 30 markets in the US, the best cities in the United States, I think it's meaningful to take a moment and appreciate the caliber of the institutional quality properties that Safe invests. So the ground leases on this slide are just a sample of the types of properties in the top markets which Safehold has closed since our inception, all with high quality, world-class customers and sponsors. In fact, out of the nearly 100 assets in our portfolio today, half are with repeat customers, which is evocative that our capital solution is really working for them. And quite frankly, it's also quite validating that we are proving our thesis. So now that you all have a general understanding of Safehold's business model, let's get to the fun part and kind of why you're all here today and learn why Safe is such a compelling investment. So as I just mentioned, 4 years ago when we took Safehold public, something really extraordinary happened. By putting a ground lease investment in a public wrapper, we democratized this investment. So what do I mean by that? Well, typically, as I had mentioned, ground leases were the domain of churches, royal families, universities, ultra high net worth individuals, because quite frankly, who has 40 or 50 million dollars to park for 100 years? I know I don't, but I do have $70 to buy a stock. Now, for the first time ever, this investment is available to the individual investor, you and I. And not only that, we can express our opinions on ground leases every single day. If we like ground leases, we could buy Safe stock. If we don't like ground leases, we could sell Safe stock. Think about that for a moment. We have turned a 100-year passive investment and gave it daily liquidity. Now that is powerful arbitrage. So Safehold was taken public by iStar, who's been in the real estate finance business for over 3 decades and has completed more than $40 billion of real estate transactions. Not only is iStar Safe's founder, but it's also its manager and largest shareholder. Clearly, having iStar's years of expertise in real estate finance and sale leasebacks, along with their robust ownership position, is extremely important in Safe's ongoing successes. iStar has offices throughout the country, and I think we all know that real estate is a local business and it's a relationship business. But most importantly for us investors, an investment in Safe contains the 3 most significant characteristics that any investor should seek, something that I like to call the trifecta of investment attributes. So let's examine those for a moment. The first is principal safety, and that's just making sure that your capital is well protected. Our Safehold ground leases are literally one of the safest ways to invest in real estate since they occupy the senior most 30 to 40% of the capital structure. Akin to taxes and utilities, you must pay your ground rent. We're even senior to the leasehold lender. And that means if that tenant doesn't pay the mortgage on their building, well, what will happen? That bank will foreclose, but then the bank will be responsible for paying the ground rent. So we're even senior to the bank. And also having a portfolio of great ground leases in fantastic locations adds an additional layer of safety. The second attribute contained with this investment is growing income that's achieved through long duration, contractually escalating cash flow streams. Our ground leases are structured with 2% annualized rent bumps that compound over the life of the lease. And I think we all know like the power of compounding is literally a page out of Warren Buffett's playbook. I think even Albert Einstein called it compounding the 8th wonder of the world. When you compare comparable AAA-like bonds with a similar duration, this 2% compounding bump structure within Safehold's ground lease portfolio creates excess returns exponentially greater than other investments with similar risk and maturity profiles. I'll get a bit more specific about these cash flows in a moment. And lastly, and this other, the second leg of value on this stool is this whole idea of capital appreciation, which is just another way of saying, how can I get wealthy from this investment and then be able to pass that wealth on to my children and for generations to come? Well, to understand this attribute a bit better, let me remind you what I had mentioned at the beginning of the presentation, that at the expiration of the lease, not only do we get our land back, but we get the building and all of its improvements back as well. Now, I know a lot of you are thinking, it's like, hey, I'm not going to be around in 100 years, so what does this really matter to me? But in a moment, we're going to examine this store of value in more detail and understand why it's such an extremely important part of this investment. So let's take a moment and understand these ground lease cash flows that I was just talking about. As I mentioned earlier, the land is akin to a AAA bond. However, when you compare the compounding escalating cash flows of Safehold's modern ground lease portfolio To that of very similar investment instruments, typically very long-term high-grade bonds, we can generate approximately 200 basis points of excess value. A great example is MIT's 100-year bonds traded in the market every day with significant volume, and that's that gray line on the bottom of the slide. As you can see, those bonds traded approximately 3.4% yield to maturity, while our ground lease portfolio generates about 5.2% yield to maturity. Now, in the AAA CMBS world, when you can generate 25 or even 50 basis points more than your peers, you would be the best performing manager on Wall Street. We are literally generating 200 basis points wide, and that's remarkable. In fact, I don't believe there's any other similar 100-year compounding escalating cash flow in existence today with this type of growth. Now, let's get back to that third component of value in this investment, the capital appreciation piece embedded within Safehold's ground lease portfolio. So as you can see on this slide, when we IPO'd 4 years ago in 2017, we had $400 million worth of buildings sitting on top of the land that we owned. As of today, that value is $5.6 billion, reflecting a compounded annual growth rate of 97%. And while the store of value is not ours today, it will be someday because of ground leases reversionary rights. We often like to compare this unrealized capital appreciation account to a 401k. Many of us have these kinds of liquid accounts. We can't touch them yet. Hopefully we have some smart folks managing that money for us. So let's take a step back for a moment and look at this slide. And imagine you had $400,000 in your 401k 4 years ago, and it has now grown to $5.6 million. Guess what? It's quite clear to me that you would be hard-pressed to find any other asset class to have such significant growth. Most importantly for our investors, we are presently working on strategies to monetize this unrealized capital appreciation account without having to wait until these leases terminate. However, it's a bit premature to discuss this now in great detail, but this UCA account will be an extremely powerful element of this investment as Safehold's business continues to scale. That being said, something that we can all wrap our head around is Safe's overall stock performance since our inception. So let's review that for a moment. So as you can see on this slide, Safe stock IPO'd at 20 bucks and closed yesterday at around $69, growing over 240% since our inception. The four middle bars in the chart represent the four follow-on equity offerings that we've had in the interim. And I certainly would be remiss not to mention that Safe has been the #1 performing NAREIT member stock over the course of the last 2 consecutive years. And we've recently been awarded investment grade ratings by both Moody's and Fitch, allowing us even more flexibility to access capital and positioning us for continued growth as we move forward. So what's the real opportunity set that lies ahead? Well, as I mentioned earlier, it's our estimation that there is approximately $7 trillion of institutional quality commercial real estate in America's top 30 markets. Now, if you were to take 35% of that, which is the approximate value of the land, that leaves an opportunity set of approximately $2.5 trillion. And guess what? Presently, we're the only ones playing in that sandbox, and it's fantastic to be the first mover in any business. We currently have no competition, and we're running the field alone, and that is a big sandbox to be playing in. We are revolutionizing real estate ownership by making it better, more efficient, and reinventing a big part of a $7 trillion industry by offering our customers higher returns with less risk. And for the first time ever, we have made investment in ground leases available to the individual investor, you and I, an investment that provides principal safety, growing income through contractual cash flow streams, along with the opportunity for significant future capital appreciation. So I know we've covered a lot in a very short period of time, and I don't know where we stand on time, in fact. So if we have some questions, we can certainly open them up. I'm going to put my digital business card up here. So
Nice.
Please feel free to take my name and email and telephone number and ping me. If you come up with questions now or later, I'm always available.
Ian, the chat was going crazy with your presentation. They loved it. I saw a very interesting company. This is very awesome. Really good response that you got.
Great.
If you do have time for like a question or two,
Sure.
um, so the track that we're on today is called the new economy. I asked one of the presentations a little bit earlier this kind of question, and it's kind of a cool theme that I sort of want to keep going. And you did just kind of touch on it with the last couple of slides there, but real estate has been around forever, right?
Right.
If we're thinking about post pandemic and post COVID and
Sure.
technology in our face all the time, I mean, how is real estate going to be a part of the new economy moving forward?
Sure. So, I mean, there's a couple of things to unpack in that question. Look, I could tell you, being, a New Yorker and having our offices in New York City, clearly during the pandemic, there was this urban to suburban flight, right? And everyone thought this, the big cities were dead and things like that. And well, guess what? It's all turning around again. I mean, obviously, just as of yesterday, with the mask mandates going away,
Right.
everything, all of that stuff. But your technology question is a real good one because buildings are going to be smarter, right? So they're going to understand like people flow and how
Wow.
and all how traffic works and all of those things are going to be how they build buildings moving forward. The interesting part of what we do at Save is we buy the land under those buildings. So the folks who own the buildings actually do all these improvements and they pay for them themselves. And the really cool part is we get to inherit all of that stuff at the end of the lease. And
Mhm.
people are like, well, why would anybody do that? But the only thing I would leave you with is to think about when you lease a car, right? You go out and lease your nice, new car. You don't pay full freight for it when you lease it. You have your monthly payments, and guess what? At the end of 3 years, you either give it back or you buy it, right? So this whole idea of giving something back when you lease it is not a new thing. In fact, leases have been around for a long time. This is just on a wider scale, and like I said in the presentation, we're just hardwired to think because this is how we buy our homes and stuff. Is you buy the building and the land together. Well, we've come up with a solution that we can give our customers and have them make more money on their buildings, right? And they do it with less risk. So it's a
Mhm.
win-win. Look, when we have customers that come back for 4 or 5 deals, we have 100 assets in our portfolio, and we've done it in pretty short order. In 4 years, we've grown this business, to almost a $4 billion business. There's a reason why we've been the number one performing NAREIT stock over the last few years. And I think I'll leave you with this. In 2018, we delivered 118% returns on our investment. So if you bought a share of stock, you got 118% back, and last year was 84%. So I mean, it was literal. It's been remarkable, as you can imagine. Not only for our investors who are now able to play in this ground lease game, which was just only available to the like an uber elite group of folks, because now you can
Mhm.
just buy a stock rather than actually having to buy, put your $50 million in the ground and just let it sit there for 100 years.
Love it, Ian. It's a great pitch.
Yeah, but
That's like the great elevator pitch for it.
yeah,
Absolutely.
done this once or twice.
Well, we do have a bunch more questions here for Ian, but we unfortunately can't get to them due to our time constraints, our strict schedule here.
Sure.
If we could pop on the URL to get a hold of Ian, there you go. It's Ian Selig. He is Assistant VP of Investor Relations over at Safehold. It's ticker SAFE, and the website is safeholdinc.com. Ian, thanks a bunch for joining us today. Have a good weekend, sir.
Yeah, you likewise. Thanks for everybody for listening and enjoy.